ultimately what we're doing in accounting is the ultimate goal is prepare financial statements because these are the official records of the business that allow folks to make subsequent decisions from them. And so there are four basic financial statements we'll cover in this course. And we'll go through these in general and brief terms here in this slide presentation, but they consist of the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. The income statement consists of two basic components, revenues and expenses. Now, as you go through the course and you read the material in more detail, you're going to find there could be different sources of revenues and there could be multiple expenses. So for purpose of just illustrating what's going on in the income statement, I've got a real brief one here on this slide. So revenues, let's just say a company is in the consulting business. And for the month of December, for this period of time, they have generated some revenue, and that's presented on the slide. They've also have, among other things, but let's just keep it again brief, salaries expense. And there you see the salaries expense at $800. So when you take the revenue of $3,000 and subtract the $800 expenses, you have left over in a category called net income, $2,200. And that's good because you want net income. You don't want the expenses to exceed the revenue. That would be a net loss. So basically the net income is the difference between the revenues and the expense. And that's what the income statement does. It describes the revenues and expenses for a period of time, in this case 1 month, for a business. Just like you may do if you do your own individual income statement generation and say at home. You have revenues coming in from your paychecks. You have expenses that you pay on a monthly basis. Whatever's left over is your income, the net income. Sometimes we refer to that as maybe disposable income. But from a perspective of, say, a corporation, that's what we're looking at is net income here. The second slide deals with retained earnings. And retained earnings we went over a bit in the prior presentation. But remember we said retained earnings is sort of like savings. And so I want you to think for a moment, before we even get into the statement of retained earnings, let's say you have a passbook savings account. Okay, so you start the period with a balance in it. Let's say you start the month with some amount of money in there. And then during the period, you put more money into it. So that gives you an ending balance. You may take some money out, so you deduct that from that balance. That's the same operation that we're using in the statement of retained earnings. So going back to the income statement, if you recall, we had $2,200 worth of net income, sort of like their savings or what they're adding to their savings. So if we go to the statement of retained earnings for this period, and notice there's no beginning balance. That could be because this is the first month of operation. It could be they had nothing in retained earnings. But in any event, you see this dash next to the December 1st, 2009 retained earnings showing nothing in there. And then they're adding to it the net income for this period of $2,200. Now they'd be done right there, but if you recall, there's one thing that reduces the amount that's in retained earnings, and that's the payment of dividends back to the stockholders. Now they could choose to pay it all to the stockholders in terms of dividends. Most companies don't do that though, because they look at retained earnings, whatever they don't pay in the form of dividends, as a way of think about how you might use your savings. Let's say you're planning a remodeling of your house, or you want to go on vacation somewhere. You may use those savings to do that. Companies can use their retained earnings as internally generated funds to finance something to expand the business as well. And that's why typically they don't pay 100% out in dividends of their retained earnings. But in this particular case, they pay $500 worth of dividends. That means their ending balance in retained earnings is $1,700. Very similar to the way that you would work through it if this is your own personal savings account. So the statement of retained earnings. The next statement is the balance sheet. And this should look pretty familiar to you. If you recall back to the accounting equation, we said assets equals liabilities plus owner's equity. Well, here's the typification of it in a financial statement. And it's the balance sheet. Notice the very first word in the balance sheet. What is that? Balance. So this statement has got to balance If you're ever putting together a balance sheet and it doesn't balance, you've done something wrong. So let's walk through it. Okay, first thing, well, thinking again back to the accounting equation, what do we have on the left side? Assets, things that you own. So in this fictitious company here, you see cash, supplies, and equipment totaling to $26,900. On the right side, you had, first of all, liabilities, things that you owe. Remember I said anything that ends in a payable represents a liability? Well, here you go. You've got accounts payable and notes payable totaling to $5,200. Owner's equity, we said, is comprised of two things, stock and retained earnings. Well, in this particular case, their stock, we're told, is $20,000 that they've sold to individuals. So they have common stock on their books for $20,000. They also have ending retained earnings of $1,700. Now, thinking back, where did that come from? That came from the previous slide. And the previous slide showed a balance of $1,700 in retained earnings. This amount that goes into retained earnings under owner's equity is always going to be the ending retained earnings. I always tell students if they're putting together a balance sheet and it doesn't balance, that should be the very first item that you look at and trying to ensure that you're putting the ending retained earnings in there, not the beginning. Because look, you put a slide up here that shows you what that statement of retained earnings look like. The beginning balance was 0. Ending balance is $1,700. So if you put 0 in here, do you understand it's not going to balance? It's got to be the ending retained earnings. So there it is. There's the balance sheet that, again, is typified by that accounting equation and utilizes these assets, liabilities, and owner's equity. And what do? They balance. They have to balance every period that you put it together. The last financial statement is the statement of cash flows. And since this is more of an introductory course, we really won't get into the detailed statement of cash flow like we would do with a more advanced accounting course. But I just want to briefly go through what it is, what it represents, and you may see it pop up, and it's good to have a general understanding of the statement of cash flow. The statement of cash flow, again, I keep using this as an example, but think of your checkbook. Okay, I think the last time talking about retained earnings, we were talking about savings accounts. But now think about your checkbook. What happens to your checkbook? You put money in there and you take money out, right? Cash. So at any given point in time, you know what your balance is, whether you keep a real checkbook balance, one that physically you can hold, or whether you go online and do it remotely. And so it gives you a position of your cash at any given point in time. So the statement of cash flow shows the coming in and leaving of cash of a business, and so the inflow and outflow of cash over some period of time. And there are typically 3 areas that this is summarized. Cash flows from operations, and that is the day-to-day operations of the business. We call this operating activity. They generate revenue, they pay expenses, things like that. The second is from investing activities, and this deals with non-current assets. And as we get into further classification of assets, you're going to see assets are broken up by current and non-current. So when a company buys, say, a vehicle, which has a long life, that's why it's non-current, that represents an outflow of cash relating to an investing activity. When they sell, like let's say you're a Hertz or Enterprise, you sell these vehicles after you use them for X number of miles, you get cash coming in, sale of a non-current asset. And so investing activities. And then there's financing activities. Typically anything that affects the owners or investors of a company. In other words, if we sell stock, we being the company sell stock, what do we get? Cash. We go out and you borrow from a bank. What do you get? Cash. So it's increasing cash. You turn around, you pay back, outflow of cash. You pay stockholders dividends, outflow of cash. So it typically relates to the investors, the stockholders of a company. And those are the 3 major areas that the statement of cash flow summarizes. And the whole point is when you look at the balance sheet, because remember cash was an item on the asset side of the balance sheet. When you look at cash from one period to the next, let's say 2019 to 2020, it's going to increase or decrease. This statement of cash flow will show you where that increase or decrease came from in these 3 different categories. And so all it is It's a statement of position of cash, and it's different from the other statements because this is on a cash basis, not an accrual basis. And as you go through your studies, you'll kind of understand what that means. So it's different in that sense, but it helps anybody look and see what the cash position is of a company, whether it's a good position to be in or not.